To order. I believe that our PowerPoints, we are able to get those on our screen now, I believe. So, all right, Lamont, I'm not going to forget this time. We should start with roll call, right? You can remind me anytime.
We're all set?
Yep.
Controller E. Mr. Unterman. Ms. Dillon.
Here.
Mr. Rosensteel.
Here.
For the State Superintendent of Public Instruction, Ms. Zumont. For the Director of Finance, Ms. Ortega. Ms. Higa. Madam Chair, you have a quorum.
Excellent. Great. Item 1 is approval of our committee agenda and work plan. Any questions about our work plan? We kind of discussed it a little bit earlier today. Seeing none, I'd entertain a motion to adopt. Okay.
Second.
Excellent. All those in favor say aye. Opposed? Abstentions? Excellent. Thanks so much. All right, item 2, Chris, the CIO report. And again, investment committee members, I think the PowerPoint's available on your screen now. So we have
I wanted to give updated numbers, especially for the teachers in the back of the room and the room next door. Was that a yay? Because at least we have, now these are still estimated, they're pretty darn close for what we think we'll print for June 30 year end, which would be 191.4 billion in assets. There's the whole calendar year in a snapshot. And I think it's always a good lesson, especially for the members that don't track us that closely. They're going to say, wow, okay, you were 189 last June 30, you closed at 191. The return has to be barely 1% or less than that. But again, keep in mind, we have a negative $6 billion cash flow. So even if we ended right back at 189.1, we'd have a positive return because we're swimming against a current. So we actually gained a little bit against that current. But as you can see, very flat year, not a lot of gains, not a lot of losses. When you look at it on a monthly basis, there were 6 months where the portfolio added value grew. There were 6 months where it shrunk. So not surprising. And I think you're going to see that out of most pension plans. Very low single-digit returns, barely positive. And we're going to finally see some real different returns out of peers, particularly up in Canada, in the Middle East and the Far East when you translate it back into dollars because the dollar was so strong. So being a dollar-based pension plan definitely works to our advantage. So that's our official, or not our official, that's our at least close to official number. We don't have the June 30 returns yet, and I don't want to give out an estimated return yet. We'll have final numbers probably by Wednesday, but early next week. I know CalPERS is going to report estimated returns on Monday, I think is their offsite, and they do a whole press conference, news conference. We'll just issue our press release, but we'll make sure you guys see that first. But obviously you can tell with the change in asset value, pretty flat year, pretty tough year to make money. Just to quickly give you an idea of some of the indexes, now that those have been updated, the Russell 3000 on the year was up 7.3%. Small stocks basically a little bit outperformed large stocks, not by a lot. The big difference when you look at mutual funds, you're going to see is growth mutual funds just smashed value mutual funds. So some of the growth indices were up 10, 12, 11, 12%, where the value indices, some of them were barely positive. So small stocks that were value oriented didn't even go up 1%. Large value stocks, let me look real quick, went up about 4%. But value, anybody with a big value tilt will really hurt. And then when you, obviously the best performing index out of the USA was actually the NASDAQ, and it's all just due to the excitement, I guess, that way. In Silicon Valley and seeing, crazy valuations and people willing to speculate. So NASDAQ did pretty well. And as you know, it finally got back above its 2009 high for a bit during the year. Non-U.S. stocks are going to suffer, especially when you translate them back into U.S. dollar terms. So the all-world country index, ACWI, as we say, less the United States, actually dropped 5.3%. So some of our peers, particularly large peers not far away, will really struggle because half of their portfolio is outside the U.S. and half is in the U.S. So, they're going to see where the U.S. portfolio might have gone up 7%. Their non-U.S. portfolio would have actually declined 5%. And I've already seen one state, my friend in Idaho, almost an entirely public asset portfolio. They have almost no private investments, no real estate, no private equity. They've already posted their June 30 return, and it was 3%. So I think we'll see numbers around that, ranging on, real estate looked like it probably did very well last year, depending on, if you were, as we've said, if you were in the gateway cities, LA, New York, San Francisco, Boston, New York, DC, you probably did very well. If you're, certainly in the oil patch, anywhere from Texas on up into Denver, it probably struggled. The oil market hasn't been hit as bad, and those economies are okay, but with a 50% decline in kind of the base commodity they deal in, we'd expect to see some more turmoil in that part of the USA. Outside the U.S., just to give you a quick glimpse, developed markets dropped about 4%, but emerging markets are down about 5%. So the emerging markets did a little bit worse. The worst place outside the U.S. to invest, it'll surprise you, Latin America, because of Brazil, was down almost 20%. That wouldn't surprise you. But what did surprise me even was Canada. Translated back to U.S. dollars, Canadian stocks fell 15% last year. So a real tough year for all of our peers up in Canada because they're required to have a little bit of a home country bias in their portfolio, as we call it, the Canadian content. And that worked against them. Bonds had a mixed year. Long bonds were flat to slightly negative. And then the aggregate that we follow was up about 2%. So finally, what we would expect out of bonds, a pretty flat year. I can't describe, you'll read it in all of our write-ups, you'll read it in the review of the fiscal year that PCA presents. And the best analogy I've come up with is picture running a mile. And let's say you already know this is not going to be your best pace at all, but it's not your worst, just an average mile. And then within a yard of the finish line, you step in a gopher hole and just trip and fall down. And you stand up, you finish, and it's just like, yuck. And that's the way it felt. I think I sent you an email on June 25th or 6th, that Friday. It wasn't looking bad, but I was worried about Greece and worried about the markets. And then Greece closes the banks on Sunday night. Monday, June 29th, the whole world drops about 3.5%. All the currencies worked against, the euro was the weakest, but all the markets fell. Very few things went up in value. And sure enough, not enough time one day. So when you look back in last year, this will help put it in perspective. June 29th, the second to last day of the business year, was the worst day of the entire fiscal year. That doesn't help. So we did touch new highs during the year. I'll show you the graph. This is the U.S. equity market over the last fiscal year. A lot of us have forgotten about October. We did have that sell-off and some worry and some fears in October. Then we had, again, another severe winter. What a surprise. Record snowfall in Boston, so the economy was flat. And the spring has been pretty slow. As I've said, this is year 6 of a bull market. Bull markets usually only live for 5 years, so it's beyond long in the tooth. It's now, I guess it's extending its longevity. It's exceeding the actuarial tables for a bull market. I guess that's a typical theme nowadays in life. But as you can see, it was a positive year, but boy, really choppy. So here's our asset allocation as we were invested at June 30. I'm glad to say private equity, it printed a number right at 10%. I've been warning you that would probably be outside of our policy range. The target for private equity is 13. It's been trending in the high nines. And the thing you have to keep in mind with private equity is it's a 4-year investment cycle. So there's literally nothing except going out and suddenly buying a bunch of secondary offerings, which don't exist. There's not much you can do. All of that allocation has to do with what we invested from '06 on, and we're getting our '06, '07 money back. We put money to work in 9, 10, 11, 12, but it's not going to work that fast. I think in the next year, we're going to want to work with the consultants and look at that of, should that range be wider? Should there be more flexibility? Recognizing that, like real estate, it's a very illiquid asset class, and you're not going to buy it fast, and nor do you want to have to sell it fast. But I'm glad to say all the asset classes were within their target ranges. And you can see we've always been and stayed fairly close to target for most of this year. The underweight in private equity is counteracted by the slight overweight in public equity. The underweight in fixed income is a bit offset by a bit of an overweight in cash. Obviously, those two don't translate, but we're staying liquid in that part of the portfolio. So lastly, the risks, obviously, I don't know if you've heard about Greece, but it's having problems. My wife tells me not to be sarcastic, but yeah, it seems, it's funny. People are beyond overload on Greece. It's been 2-3 years of dragging on, and now it's finally to the point. Some interesting factoids. The Greek ATMs can no longer put out $20 euro bills. They're out of them. So all they put out is a $50 euro bill. The Greek stock market has not opened since June 29th. There was a hope to open it yesterday, but they were not able to. The best analogy we came up with, to back up a little bit, you remember we have a tactical asset allocation committee that's all the portfolio managers. We meet quarterly now, but we have a risk allocation committee that's a smaller group, and it meets at least monthly. During times like this, it meets more frequently. We've been meeting 2 to 3 times a week. And we met this morning first thing, and one of the comments was, picture if you went home and you said to your family, you know, Visa has given us a bill. Let's vote. Do we want to pay the bill or postpone? And everybody says, you know what, let's postpone. And then you throw a party and you call Visa and you taunt them and say, we don't care. But then you go to the store the next day and you find out, gosh, they won't honor my Visa card. What a bummer. And so the comment in the press today was some of the euphoria is wearing off the vote last Sunday. It's going to come down. Apparently France is willing to loan the money, which I think is remarkable, but Germany is trying to hold the line. So we'll see. The thing we're watching is the Central Bank of Europe Draghi had made statements all last year and all this year that he would protect the euro no matter what it takes. Didn't say if that meant Greece was out of the euro, but that's, their central bank easing is a key part of that divergence of central bank moves that we've been watching. So that still remains a big key. Obviously, Greece remains a big key of concern. I would emphasize again, I think people, how big is its economy? Size of what? Rhode Island, right? Rhode Island, Wyoming. We have been following also China. I handed Harry and Sharon a chart of China. One of the things you have to realize is that the volatility in the Chinese market is only in the A shares, which are only for local investors. We do not invest in the A shares. That market has been volatile ever since it got created. It was up over 100% in the prior year. So to then turn around and drop 50, 60%, while that's horrendous, people are recognizing the volatility. And you also have to realize that the central party has been stimulating and encouraging people to the point that some officials made comments about people should take the money out of their homes and buy stocks. They've been encouraging people to buy stocks. And I guess you got to be careful when you tell 3 billion people what to do, because then as they go in, the market runs up, and then when they want to come out, and so they've put in short selling restrictions, all kinds of different restrictions that have had little impact. it impacts Asia when it opens, but not dramatically, and it hasn't carried across the whole world. It's just made people nervous of, as China opens up their market. Yeah.
This is only A shares, so that, is there a different market? I guess I just don't understand China's stock market.
No,
Are there multiple
Number one,
markets, or?
the currency doesn't free float, and it's not easily convertible. So at some point, they have talked about opening the A shares to foreign investors, and you can get a QFI, a qualified financial institution status, which would allow you to invest in that market. Some of our Canadian buddies have done that. We're mostly exposed to the Hong Kong market, which, so if you look at the A share market, straight up, and now this sharp drop, the Hong Kong market rose a little bit, but not nearly to that level. And one of the things China tried to do to recalibrate them is allow mainland China investors to invest in the Hong Kong market for the first time, to try and bring them back together a little bit. But there still was a big gap. The same company might be listed in Hong Kong as is listed in the A share market. One stock is really high and one stock's only a little bit higher. So the international investors have been a lot more rational about China and slower. And that's mostly our exposure. Do you want to add anything?
Yeah.
Wait for closed session.
No? Okay. But we're going to continue to watch it. What everybody worries about is the Chinese economy, because that is material to Japan, Southeast Asia, and even to the U.S. They're trying to slow their economy from a growth rate of 9% down to 7%, maybe 6%. Some people fear it's as low as 5 or 4. We've talked before, they've built out a lot of infrastructure, entire communities, assuming people are going to move from the farm inland, so you worry about home prices. They've also built out a tremendous amount of infrastructure, assuming the jobs are there. If the jobs aren't there, then what happens? So it's the challenge of, again, managing 3 billion people. On the positives, which there are some, but you don't hear about them in the press very often, our Federal Reserve is still in a neutral stance. We're going to hear more from their minutes about how you'll hear them talk about they may tighten in September, or they may tighten in December, or they may push it off to February. The likelihood is somewhere around December. Again, 1/4 of a point, moving from 0 to 1/4 of a point. I don't think you'd rush to the bank to get that 1/4 of a point. It's not so much the move, it's the fact that it's a change. For the first time in 7 years, the Federal Reserve is increasing interest rates, not keeping them flat or lowering them. So the markets will react to that. And the big question you're going to hear people debate in the summer and the fall is how high and how fast. Okay, so once they change direction and start to tighten, how fast are they going to tighten and how high will they go? They would only tighten if there are two things: inflation and a really strong economy that makes them fear inflation. The economy isn't that strong and inflation is not a problem. So there's very little motivation other than they want to get off 0. They know they need to move off this easy money situation. But we're going to see a divergence of the central banks, U.S. and Bank of England, BOE, tightening, ECB, European Central Bank, and BOJ, Bank of Japan, easing. So that's an interesting move for us. GDP in the U.S. looks to be around 2 to 2.5%. That's okay. Very low interest rates, and the PE ratio is reasonable. Right now, if you look at our graphs on risk, it's a bit high. Not extreme high, but a bit high. I think the attention on Greece will wane a bit because corporate earnings are starting to come out. So Alcoa reported yesterday, we're going to start hearing about corporate earnings for the next 2 weeks. They will probably surprise on the upside because CEOs are smart and they downplayed expectations. And analysts don't want to get disappointed, so they downplayed their expectations. But what we're really looking at is, okay, how much did earnings grow over last year? Are they growing at a 6% rate, or are they really only growing at 1 or 2%? That's really going to tell us where the stock market's likely to go out in the next 6 months. And we think, unfortunately, it's going to be pretty darn flat with very little growth in earnings. So it's going to be a challenging market. So with that, I'm open to any questions you might have.
Got Harry.
Thanks, Chris. So, with all of the uncertainty that remains in the world, um, does that make the United States the safest neighborhood in a dangerous world, and potentially is an advantage for us to be looking at, like a flight to safety? We might see more capital flowing into the U.S. markets, people fleeing from other parts of the globe and saying, rule of law, best place to be is still America, real estate, etc. Possibly that could work in our advantage.
It does, and it already has. You'll remember the phrase, we were the best dirty shirt, or the least ugly dirty shirt in the market, because people were worried about when Congress was messing around with the budget and not passing a budget, everybody else was in worse chaos. So right now, we're not growing fast, but we are the safe haven. So on the 29th, the things that go up in value are our 30-year bonds, the dollar versus most currencies. And surprising to a lot of people is the yen rebounded, because the yen had sold off so much. People wanted to go and looked at Japan as at least an economy that's trying to improve. And it's back to that issue. It's not more U.S., which they already have exposure to, and it's certainly not Europe, and it's not Greece. So I think we're going to still see that. We saw a rebound. Interest rates started to climb back. The long bond went back to about 3%, a little more than that. And then sure enough, it's rallied. In other words, prices have come down. The yields have come down. Prices have gone up. So we're looking at the portfolio as using long bonds more as a hedge to the equity portfolio, not for the return, but for the insurance contract. I don't know about real estate. I think we're already seeing that in real estate. When we put buildings up for sale in the market, people are buying them at, and again, cap rates are the opposite of PE ratios. So a very low cap rate tells you kind of the implied return somebody thinks they're going to get out of a property going forward. And you've heard Michael and McGee tell you all the time, the median is 8. The answer is always 8 is what you want. If cap rates are above 8, that means real estate's cheap, you want to buy. If they're below that, it's kind of fairly priced and you want to watch it. We're seeing cap rates in the 4% to 3% range on prime office properties in these major cities. We just scratch our head. We sell it to them because we scratch our head and say, I don't understand that. How can you take such a low return? But like Harry's saying, it's because in their country or in their currency, they're going to lose money. And so they'd rather just make a little bit here because they get a return on their capital and they get a return of their capital.
Maybe we can hear from
Yeah,
our consultants on there, how
Yeah.
they see
I
it.
was just going to ask
You know,
Stephen and
And these
Well,
are
a
big
couple-
issues,
Yeah.
Couple
the
of
mic.
macro issues
How
that
do
are
you
taking
guys
couple of
see the
place.
world?
How do you
anecdotes.
see it?
Sure. Volatility has risen, right? If we go back about a year, it was pretty benign. There's an index called the fear index. We can all look at it in the paper, on our phones. It had a number that was about 11 or 12, 18 months ago. So that spiked to about 20. But the 11 or 12 was too low, and the 20 is normal. So the overall volatility that we're sort of dealing with is, in a sense, normal volatility, not spiking volatility. Now, if volatility spiked, we saw that as VIX as a gauge spiked to 35 or 40. That's pre-crisis. That's pre-2008. That's people getting worried. But at the 15 to 20 range that it's in right now, and it's right at 19, that's where it closed today. That's where it's historically, that's where it sort of behaves. So the interesting thing is we have these interesting little pockets of volatility, whether it's in Greece, which is a very interesting chess match kind of issue long term, or we have these markets in China, which are bouncing all over the place. And Chris sort of gave, and Sharon asked the question, and Chris sort of gave the nuanced answer. There's different markets in China, so you got to be careful about what you're looking at. But just to sort of highlight it, just some numbers for you. The Shenzhen, that's the A shares that Chris was talking about. It's been in existence since about 25 years in one form or another. But if you think a negative 5% is a bad day in the market, how many times has the Shenzhen been down since its inception, the last negative 5% or more? Anybody have an idea? Probably not. It's been down over 100 days So that's still, there's several thousand trading days in there, but still, that market that you've been reading about and sort of getting worried about what's going on, what's broken, it does this. The point is, it does this. On the contrary side, it's been up over 5% 100 days or more in its life. In contrast, the U.S. market, S&P 500 over the last 50 years, it barely ever touches 5%. It was down over 5% since 1950, 60 years, only 14 times. And it's been up over 5% only 17 times. So the American market doesn't move like this, but these other markets do. And the interesting thing is we're just getting a better glimpse now with global communications, 24/7 news cycle. We're just seeing all this stuff, almost when it happens. And so, I think to your point, Harry, we're sort of at a normal we've come back to a normal volatility age that we want to be very careful about overreacting to. So, and I think on the notion, I think your notion about is America the safe place? I think in a crisis it definitely is, but as we see, like the euro weaken, some of these other currencies begin to weaken against the U.S. dollar, and particularly if the Fed comes in and starts raising interest rates, there's a lot of smart money that's moving to corporations that are located elsewhere. So is BMW going to be more competitive as the euro weakens versus GM, which is located here? And the answer is probably yes. We're probably all going to go out and buy more BMWs than we did in the past because they're more affordable. So some of these global corporations are in better positions, could be in better positions going forward as a result of these activities that are taking place.
I'll just add, for the purposes of your portfolio, what's really important for China and Greece is to what extent they represent systemic risks, because obviously you don't have much, if any, exposure to the country stock markets directly. Thankfully, so far at this stage, it does not appear that either represent significant systemic risks. On the Greece front, that's largely because in the last 5 years, we've been in the same spot 2 or 3 different times already. The European Central Bank has several plans to mitigate systemic risk if Greece were to either voluntarily or involuntarily exit the euro. And in China, to what both Neil and Chris were alluding to, the volatility has been in the domestic market in Shanghai, which is, for the most part, a closed market to outside investors. So there are not the obvious channels for the volatility there to spread elsewhere. Though certainly yesterday, with the Hong Kong market down 4 or 5% and a lot of the Asian markets down a couple of percent, that's something to keep an eye on. But at this stage, these look like reasonably isolated events that are not going to impact the global markets or global economy more than sort of normal levels of volatility would show. I'll note a couple of things under the radar screen. The IMF came out yesterday and revised down its global growth estimate. It did not revise it down because of Greece or China. It revised it down because of slower growth in the U.S. That's partly caused by a really bad print in the first quarter of U.S. GDP. And much like we saw last year, once you have a bad quarter, you only have 3 quarters to make up the difference. And so as a consequence, the IMF reduced its forward-looking expectations for the U.S. GDP this year. It also pointed to higher oil prices starting to serve as a drag relative to the IMF's initial expectations when oil was at $45 to $50 a barrel. So despite all this, I don't think one should lose sight of the risk in the U.S. economy and the U.S. markets as well. In terms of the biggest risk going forward, apart from the obvious global macro risks that we've discussed, the rising dollar is a big risk to the U.S. economy, to the U.S. markets and corporations, and for pension funds like yours that have liabilities that are paid in U.S. dollars out 20, 30, 40 years, but an investment portfolio that has some fraction of its investments in non-dollar currencies. You want to see over the long term anyway the U.S. dollar weaken somewhat to benefit from strengthening currencies. And arguably the global economy is healthier when currencies outside the U.S. are strengthening, because that generally means that the economies are growing and are healthy outside the U.S. as well. So in the near term, yes, a strong dollar makes things cheaper. It makes our economy more attractive for investment, but the long-term impacts aren't as clear. And as we see the corporate earnings cycle, much like we saw in the last cycle, you're likely to continue to see corporations that do underperform point to the rising dollar as a reason for that underperformance.
Chris, did you want to-
One last thing, not on the markets, I want to introduce a new staff position that I didn't do last month, but we have after a very competitive process of candidates, all inside STIRS, but it was very competitive. We selected Deborah Smith selected a new director of investment operations, and her name is April Wilcox. Stand up, April. April has spent 10 years in the investment branch. She started in operations, then went to fixed income, and now is the director of operations. And she has about 15 years of overall professional experience. A BS in finance from Sac State, Claritas investment certificate, and she's CFA level 2 candidate. So we're thrilled to have her on board, and that completes my report.
Any other questions from investment committee members? I did want to draw attention to a couple of things for our board members. If you take a look at our board website, I just want to make sure you're aware that in Paul and I's meeting on Tuesday, we were kind of reviewing how we can provide, investment information to board members as well as the public in a more effective and efficient manner. And so when you look at the front page of our board site, you can kind of click on in the corner under quick links. There's investment videos, which are excellent. So if you haven't taken a look at those yet, they're really short, but they're wonderful on each of our asset classes, and just gives you kind of what are the hot topics, things to be thinking about. Also quarterly reports. There's even a glossary if some of the language gets. But I did want to kind of call your attention to that. The other thing we're doing, and I hope the communication staff's in the room, Chris Ailman is becoming very popular on television, on Bloomberg and other sites. And we've had, we get our daily board clips, of different things to read. We're having, Chris's, his videos at the top of those lists. And I'm requesting today that we actually get a heads up ahead of time when he's going to be on something. Because I know for me, watching his analysis, and especially as he's interviewed with different folks, it gives a good snapshot about what are people thinking about in the economy. And so I think it really adds a level of prestige to us to have you out there. I really appreciate the work you do out there, and I think it's also a good educational opportunity for us as board members to learn from you. So that's great. And then the other thing I want to mention to the public out there and the teachers in the room, that if you go to our CalSTRS.com website, there's an investment tab, and we're working hard, so that any teacher or any member of the public can look at our tab on the investments on our website to be able to see our asset allocation, the companies that we invest in. There's even going to be more educational videos to help just the general public understand how we invest and why we do what we do. And I just think that's another important piece of our role as a public institutional investor, to make sure that people understand where we invest, how we do it. So I really appreciate the communication staff and the investment staff for making those educational opportunities available, and we'll continue to get better at that. So check those out. Thanks, Chris. All right. Now I need to get back to my list here. Okay. So item 3 is approval of the minutes from our June 12th investment committee meeting, open session. 8 pages. The first, I just noted the first 2 pages were just the people who are present. That was a well-attended meeting. I'd entertain a motion to approve. Okay, second. Great. It's been moved and seconded. All those in favor say aye. Aye. Opposed? Abstentions? Excellent. Thank you. Our minutes are approved. So item 4 is part 4. I feel like this is like a mini series, right? Thornburg. Oh wait, that's kind of old school. Let's see. What's a new mini series?
This is
Wolf
far-
Hall. That's been my favorite.
This is far more dramatic.
PBS. Wolf Hall. Hopefully this has a better ending than. Yeah, it's Henry VIII. Yeah.
The lead
PBS.
actors.
I love it. All right, so today we are, sorry, I'm having some technical difficulties here. So today, this is an action item, and this is, again, like I said, part 4, so we're adopting asset class constraints. So it looks like we've got Josh and Stephen and Neil to walk us through it. And I think as you walk through it, I think the main piece I want to make sure that board members are clear on is just, how these constraints, obviously there's different opinions, but, and then sort of, as we adopt those constraints, the implications for our asset allocation study, so. Thanks, Stu.
You're welcome, Madam Chair.
welcome.
Before I begin, I'd just like to have some introductions. To my immediate left is Steve McCourt of Akita, one of your board consultants. And to my right, who you've met before, is Josh Steedish, and he's an investment officer within my group, heads of the risk and asset allocation group. And then to my far right is Neil Rue, a PCA, your other board consultant. So, Madam Chair, like you said, this is the 4th part of a 6-part series, and so it's just good. Now we're towards the latter half, past the halfway mark, correct. So I just like to, before we get into today's study, I just like to recap where we've been, and just to make sure we're all on the same page. So back in February is when the study kicked off, and we set the groundwork and the framework and identified what we'll be covering during the study. Then in April, you made your really first important decisions. This is where both of your consultants came to you and identified what are the asset classes that they will be modeling. Then next, what happened was in June, you adopted the capital market assumptions. You were looking at a 20-year horizon, and part of those capital market assumptions, you were looking at expected returns, volatility, and correlations. And today brings us to our next decision, and that's looking at constraints. And what that really simply means is just looking at what are the minimum and maximums that we'll set for each of the asset categories that will be modeled. And so today's presentation will start off with Josh, and he'll talk about constraints. So what do we mean by constraints? What are the constraints that we're proposing, and the sort of reasons why? And then he'll set off by giving a couple examples. Then after Josh completes his presentation, you'll get to hear from Steve, and he'll have some comments regarding constraints. Following Steve, you'll get to hear from Neil and PCA, and they'll have some comments. Then after the comments are complete, you'll have a chance to ask us any questions that you may have. So with that, I'll kick it over to Josh.
Thank you, Stephen. So as Stephen said, really all these are, at the end of the day, are limits on the minimums and maximums for the different asset class weights. And we developed these in consultation with both of the consultants. And there are there are a variety of reasons why you want to have constraints in a process like this. There's really 3 main ones, though. One is, and we kind of hit on this in the memo, is whenever you do any kind of optimization, and people are most familiar with kind of a classic mean variance optimization where you find the highest return for a given level of risk. But any type of optimization is focused solely on the numbers that you put in, the inputs that you put in there. And so if something is slightly better than something else, it will tend to get an extreme weight. And so that's one of the first reasons why we put these constraints on, is just any kind of numerical optimization can give you something that looks pretty extreme. Another reason, it really has to do with with feasibility in general. So, the market opportunity, when we look at something like U.S. equities, where it's a deep and liquid asset class, and we come up with the capital market assumptions that we came to you with in June, we figure we can earn that level of risk and return pretty much however much you put into the asset class. But there are some classes, like private equity is a good example, and real estate, where the opportunity to earn the type of return, the premium that we expect to earn is more limited. And sort of along those lines, along with that is the staffing and kind of infrastructure requirements that you have in some of these opportunities. So we have limits on what we can do there. And then also in terms of just the implementation and how long it takes, with the more liquid asset classes, if you change, you put a particular weight on, you can get to that target much quicker. Something like private equity or infrastructures we've seen, or real estate, asset classes that are more illiquid take much longer to actually get to that target. And we're doing this allocation with a 20-year horizon, but we do revisit it every 4 years. And so we try to strike that balance where we want to have constraints that are somewhat practical in the next 4 years, and also thinking about that long term, that some of these classes we may not get to a really high weight in a short period of time, and that would take over multiple studies perhaps. And then the last reason really is just in general, it's a way for us to bring a little bit of professional judgment and kind of subjective judgment to the process, because everything we've done up to this point is really kind of about just the numbers themselves and the assumptions that we put in, but we can never fully capture kind of the flavor and the complexity that exists in a portfolio like this and in this kind of process. So this is a way for us to bring that judgment into play. And so I have 3 examples of constraints that I think will kind of make some of these points a little bit more concrete. So if you look at INV 20 has the tables of constraints that we're recommending for you to adopt. And so in PCA's table, there's a category private growth, and in table 2 in Makita's private equity. So those are both really the private equity constraint. That's something that's common to both of them. And that really is, and same thing with real estate. Those are both pretty good examples of constraints that are basically the same for both of them, and really have to do with the market opportunity that's available in those asset classes and what's feasible for implementation, both with the staffing and kind of reasonable staffing levels and what we can accomplish over the next few years. Another one that's common to both of them is the risk mitigating strategies. And that really is a combination of things. So one of them is feasibility. And as a new class, relatively new class, there are components within there that we're investing through the innovation portfolio in smaller size, but sort of a realistic implementation plan between now and the next study. The possibility that you could, because it does what we're assuming in the capital markets assumptions, and we believe that this is a valuable class, it provides good diversification to the rest of the assets in the portfolio, particularly all of the equity risk that we have in the portfolio. You could end up with a pretty extreme weight. And so this is sort of where the professional sort of subjective judgment comes in. We believe in the class, but it is new. And so in doing something like this, we want to put a reasonable constraint on a target weight as we would ramp into a class like that, assuming you allocate it to it.
Josh, can I just jump in and because I'm listening to this, I read it beforehand, and I'm just finding it conceptually it's hard for me to understand exactly, from 0 to 12, it just comes across sort of subjective, and so I'm just, and I understand the 3 different, pieces that you just described, but I guess it would be helpful to understand a little bit more of what's the thinking behind developing those particular numbers. I mean, because 0 is 0.
You're right. So it is.
It's sort of, so I'm just trying to understand from 0, like for example, with with risk mitigation. Let's pick that one from 0 to 12%. How do we get to 12?
Yeah, and you're right. There's a high degree of subjective judgment and professional judgment that goes into that, and that was really the product of discussions internally, staff with both consultants, and looking at what we thought was feasible implementation. So if you were to allocate to that class, how big really do we think that portfolio could get between now and the next study in 4 years?
Let me say it in a real practical way. Right now, we have $1.3 billion. If it maxed out, that'd be 24 billion. 25 billion. So to be time diversified, to not just throw money at something,
Right.
we're like, we just thought that even ramping up to 30 billion is a real reach. We'd be lucky to get up to 25 billion. I guess not lucky. To do it smartly, it would take 4 years or more to get up to that high. So we put that constraint. If the model maxes out in it, then we can all debate about, maybe we should consider ways to get there faster. But you're talking about buying, again, price matters, and you don't want to buy into some of the markets at this level. The same thing with real estate and private equity. Those portfolios are 20 to 24 billion now. As we talked about in private equity, we're having a hard time staying up at that level. It would mean putting big allocations out right now in the next 3 years when we think the markets are pretty fairly valued. So that's a part of when we, as Josh said, we come back and take a look at practically what really makes sense to do in here, knowing 4 years from now there'll be a new asset allocation study, and we want to be sensitive to timeframes and to price levels. The min and max in like global equity doesn't matter. He was about to get into fixed income, but
I don't mean to get ahead of you, Josh, but obviously public equity stands out too. So 20 to 70%, that seems like a broad range. So.
And it is, and I think, and with some of these constraints, it's really, I think we made the point in the memo too about how, there are some that will be more important in what we would call binding constraints, where you're actually going to bump up against your limits. For all practical purposes, with global growth or the public equity limits, pretty much any reasonable portfolio I think that you're likely to see will be within those ranges. And so, in some extreme case, I suppose if you went to that limit, we wanted to have really a maximum where you would have some assets, some other diversifying assets, so you don't have a portfolio that's completely dominated by equities. And that's really what that comes down to. But that, I think, like Chris was saying, that one probably is going to be less important, and there are a couple others that are less so, and some that are more important. And so then I think the last one, sorry.
I get the idea of the max for certain of these categories, for policy or risk management reasons. It seems like it makes the minimums almost not null cases. I mean, they total 35-40% of the portfolio, and I'm not sure how meaningful they are, other than, I guess, private equity. We couldn't get out of it any faster than that. So we know that's going to be there. And I guess real estate's more or less the same.
I think you're right. So those two are probably ones where they matter a little bit. I think the most important minimum that will matter will be in the fixed income related assets. And that was probably the area where we had the most discussion, was really about where we would set minimums to fixed income. And I think the staff view, our internal view, is that that a good minimum is something like 15%, and that is what Makita proposed as well. And where it gets a little bit more complex is particularly in the PCA approach. The things that you traditionally think of as fixed income are spread across a few different classes, and so there's going to be some nuance that will come in with fixed income assets. It's possible that when we come back in September, that you could see traditional fixed income assets, when you added up the pieces that are spread around in the different classes, could be quite a bit less than that. And I think that's where we would have that discussion. I don't think there's nothing wrong with having the flexibility to model portfolios that can have a lower allocation to fixed income, but I think it would definitely open up a discussion in September and November if we saw recommended portfolios that had substantially less than that in traditional fixed income assets. And that's really just a function of it's the most proven asset that we have as a diversifier to the substantial growth risk that's in our portfolio. So what you see here, like I said, it may be different. but it's still too soon to tell until you really get into the modeling and see what these portfolios will look like. But to your question about the minimums that matter, that's really the one that's going to matter the most with the expected return characteristics of fixed income, even with the great diversification that it provides. An optimization model will tend to drive fixed income down pretty substantially.
So, one thing that would be helpful for September would be to see how our, particularly with respect to the PCA, where they've, in the course of this process, basically have proposed a whole set of categories that don't map to the way we report. It'd be helpful to see what is at June 30, what we have in our portfolio that maps to their categories and to the Makita categories, and so we could see what the composition is in these different looks with some tangible frame of reference.
Well, to that point, it's funny you asked that. You mentioned that because prior to this meeting, we were discussing and getting ready for September, and that's definitely something that we plan to show you is, what our current policy portfolio is and mapping both Makita and PCA into something of a common framework so you can make those side-by-side comparisons.
Yeah, and just what the actual totals are, because we've never looked granularly down at emerging market equities, for example.
So can I follow up on that?
Yeah.
Well, Mr. Underman, you've asked that question 2 times now, both in the last meeting and this meeting, so we want to make sure we're being responsive to your concerns. So I want to flip you to page INV 24, and this is how we're mapping out the PCA classes. This was in the write-up for the last session. Just based on time, we didn't get into the details of this schematic, but I just want to make sure that you in particular see this schematic because you've asked the question a couple of times. And hopefully it makes sense the way it's organized, but you have the big blocks represent each of the strategic classes, and then a couple of columns over, within each block, you can see the subclasses that we utilize and how those will be allocated among the classes. Now, those smaller subclass allocations that all add up to 100% for each block, the difference between PCA and Makita is that those allocations that we have and within each block will not change. Whereas in Makita, they're going to let them float a little bit. And I think this gets to maybe Mr. Rosensteel's interest in seeing what's the impact of having a lot of classes float around a little bit versus doing it at a higher level. So this is where you're going to potentially see some contrast in the output.
I appreciate it. I did see this chart, and I understand the difference there. I was just asking to see dollar amounts opposite the different percentages so that you could sort of tangibly see what we're talking about here. I understand the philosophical difference between the two of you in terms of how you're defining these categories.
Okay, we love this stuff. We get to debate it. This is what we eat for breakfast. But I want to make sure it's real to the rest of you. You've all heard about the classic 60-40 investment portfolio. That 40% is in fixed income. This fund for, 20 years had a minimum of 50% in fixed income. Then in 1983, we adopted the prudent person standard. We went to a 70-30, then a 75-25 portfolio. And that's where most pension plans always were. Then we dropped to 80-20, and at the last asset allocation, we said the minimum for fixed income was 15. So that minimum is a real number. It is something you need to pay attention to. Most of the endowments, so I'll pick on Harvard, Yale, Stanford, they're all the way down in some cases to 2%, 5% in fixed income. They use other categories, so if you add it up, maybe you get up to 10, but they've always been very different. They have a different liability stream, so kind of forget about them. This relates more to from a fiduciary counsel standpoint of how different are we allowed to be versus our peer group. Our peer group is generally still around 75-25. The challenge is, and the reason we're looking at such low levels of fixed income, you've heard me say it, Neil, Stephen, Alan, we're at 200-year lows in the United States in interest rates, 300-year lows in interest rates in the UK. So fixed income isn't just fixed income anymore. It's not like the phrase, it's not your mom and dad's fixed income. It's a brave new world. Is it that conservative? I agree with Josh. It is a diversifier away from equities. But frankly, we've had entire streams of 5 years where bonds moved in the same place as equities. I pulled out, given this discussion today, give me a second to find it again. The 30-year return for stocks is 10.7%, and the 30-year return for the aggregate is 7%. So actually pretty darn close. We're recommending 15. PCA is recommending free floated, which could be as low as 10. You don't have to decide that. The model will free float, but I just want to make sure you understand that's the nuance of how other people will look at us and go, wow, okay, what level do we kind of feel comfortable? Do we let go of the old days and the old 60-40 as a mantra, and do we adopt a braver new look and be investors that way? Or do we constrain the model and say, and this happened in the past where the board just said, I want to have 20% in fixed income because I just feel like that's what I need. Maybe it's not a good investment, but we want some diversification. So I just want to make sure you guys stomach that and noodle on it for a while.
All right, Paul?
So I appreciate that, Chris, because I wonder how much of what we're doing here is actually making choices, not just making decisions about ranges. Like I wonder whether anybody here recalls, because I don't, when we went through this the last time, my recollection is that our allocation to private equity and real estate was at the maximum of our range. And our allocation to fixed income was at or close to the bottom of our range?
Correct.
So, in fact, and then what the rest of the portfolio is basically public equity, right? I mean, that, and then there's small amounts elsewhere, but I mean, that accounts now for 90% of our, so in reality, unless our capital market assumptions are dramatically different than where they were last time, or our risk parameters as a board are dramatically different from where they were the last time, we're largely making a decision, I would think, correct me if I'm wrong, about asset allocation by the determination of these ranges, because whatever we say is the maximum for real estate and private equity is probably close to where we're going to end up, and wherever is the minimum with respect to fixed income is pretty close to where we're going to end up. Is there any reason to think that, that's not going to be the case this time?
Well, I think you make a good observation, Paul, and if you look at you look at INV 20, you look at the minimums, and you've got under the PCA, you've got a minimum total of 30, 40, and I think it's under Makita, you got 20, 40, 45, so pretty close. So you got 45, and then you're gonna bump up against some maximums. If you just sum up the minimums, you're going to have that in the portfolio, and that's sort of the point you're making. You're going to have that already going into the asset allocation.
No, I'm not. I'm making the point that just like we did the last time, coming up that we ended up at the maximum for real estate and private equity and the minimum for fixed income. Is there any reason to think that this time around, when we finish our whole process and we do
Will it be any different?
Will it be any different? Will we come up with, will we once again be at our maximum for real estate and private equity, which according to these numbers would be 13% each, and that our minimum would be for fixed income would be, whether it's 10% for PCA or 15% for Makita. Is there any reason to think that that's not what's going to happen again? Because if that is what's going to happen again, then these decisions today are really the most important decisions, because they're really going to determine, regardless of what happens after today, they're really going to largely determine where our asset allocation is. So I'm just asking, is there a reason to believe, given the expertise that all of you have, knowing the capital market assumptions we made, making the assumption that our risk return parameters or preferences as a board are probably not too dissimilar from what they were the last time? Is there any reason for us to believe that we're not going to end up with 13% private equity, 13% real estate, and somewhere between 10 and 15% fixed income?